What if I told you Europe is being reshaped, not by armies, not by trade wars, but by silent checks, discreet boardroom deals, and state balance sheets operating behind closed doors? Not the kind of headlines your morning paper screams. No scandal, no dramatic protests. Instead, the new players write quiet purchase orders, park capital where the law and politics are stable, and wait. Decades of industrial decline get repurposed into logistics parks. Heritage buildings become headquarters. Soccer clubs become soft power instruments. The buyers? Sovereign wealth funds, state-owned investment pools from places like Abu Dhabi, Riyadh, Qatar, and Kuwait. They sit on the world's spare cash. And if the past decade taught us anything, it's that when sovereign wealth funds decide Europe is attractive, they move silently, deliberately, and at scale. Bloomberg estimates Gulf sovereign wealth funds deployed tens of billions globally in recent years. But why now? And how do they do it without triggering alarms? This is a story about power that looks like investment, about influence that arrives as finance, about Europe being bought quietly, one asset at a time. Section 1. The new geography of capital. Sovereign wealth funds, SWFs, have been around for decades, but the post-oil diversification era has changed everything. Gulf funds, from Saudi Arabia's public investment fund to Abu Dhabi's Mubadala and Adia, have grown into mega managers, and they've set their sights on Europe. Global trackers show a stark trend. SWFs are no longer passive holders of foreign reserves. They've become deal makers. The global SWF platform documents a steady increase in direct investments and co-investments across Europe over the last 5 years. Why Europe? 3 reasons. First, political stability. Second, deep liquid markets. Third, strategic assets, ports, data centers, energy infrastructure that promise long-term yield and influence. These funds aren't chasing a quick flip. They're buying cash flows, control, and options. Take logistics. The e-commerce revolution needs warehouses, distribution hubs, and connectivity. That's where money lands. Take tech. Chips and cloud infrastructure are essential for the next economy. That's where sovereign funds want stakes. Reuters and Bloomberg have repeatedly reported Gulf funds increasing focus on tech, infrastructure, and logistics. So the map of Europe is re-annotated not by invasion lines, but by investment categories. Ports and terminals in the north, logistics parks across the old industrial belt, office towers in city centers, and data centers in the countryside. Section 2. The playbook. How they buy quietly. If you watch the deals closely, there's a method to the silence. First, patience. SWFs operate on multi-decade horizons. They are less sensitive to the quarter-by-quarter pressure that haunts hedge funds. That lets them buy when others hesitate. Second, partnerships. They rarely go alone. JVs with local pension funds, co-investments with other sovereign funds, or alliances with global private equity. They show up as local capital, not foreign sovereign diktat. That obscures the flag behind the check. Third, financial craft. Take the common structure. Acquire a minority stake in a company. Gain board influence. Build relationships with local politicians and banks. Then acquire incremental control via debt or stage purchases. Often, the first purchases are labeled strategic minority investments. But in 5 years, those stakes can become dominant. Global SWF and FT reporting show numerous examples of stage market entry and increasing deal flows from Gulf funds into Europe. Fourth, soft power packaging. Buying a European football club or a landmark hotel looks like cultural engagement. It's also a diplomatic asset. It grants access to political networks, high-profile relationship building, and PR that smooths future investments. Finally, they leverage the local appetite for capital. Many European governments and corporations are desperate for investment, for post-industrial regeneration, decarbonization projects, and tech scale-up capital. Sovereign funds arrive with large checks and few strings on job promises, and they win hearts of local elites. The narrative quickly shifts. It's foreign capital, but it's about jobs. Meanwhile, control accumulates. Section 3. Real examples, names, deals, and patterns. Let's move from patterns to people. Abu Dhabi's Mubadala and the public investment arms have been large spenders in Europe, from infrastructure to corporate stakes. Bloomberg and the Financial Times document extended deal pipelines across energy, tech, and industrial assets. Saudi Arabia's Public Investment Fund, PIF, has been conspicuous. From gigaprojects at home to private equity check writing abroad, PIF's appetite for high-profile assets has grown. Reuters recently reported PIF's planned green bond issuance in euros, a sign of deeper European market engagement. Then there are more subtle plays. Some Gulf funds have moved into European real estate through holding companies, acquiring chunks of logistics portfolios, or financing renewables. Reuters' coverage of Adia's strategy shows a shift toward tech and private credit overseas. And if you want a headline that registers with the public, sports. The purchase of high-profile soccer clubs by state-backed entities gives a face to otherwise opaque finance. Those deals are perfect PR. They rebrand foreign capital as cultural patronage. Global SWF's 2025 reporting catalogs increases in deal volumes and co-investments, noting that Middle Eastern SWFs deployed record sums in various geographies last year. If you add up the flows, you see tens of billions redirected into European assets. Not all disclosed the same day. Section 4, the strategic targets, what they buy and why. Not all assets are created equal. SWFs target 3 categories again and again. 1. Critical infrastructure, ports, energy grids, data centers. Owning a port is owning trade access. Owning energy assets is owning future decarbonization value. Data centers are the nerve centers of the digital economy. 2. Real estate and logistics, warehouses, logistics hubs, and industrial parks. These yield steady cash flows and hedge inflation in a world of supply chain reconfiguration. 3. Strategic minority stakes in tech and finance. Buy into banks, fintechs, or cloud players gives exposure to innovation and control over ecosystem partners. Why these 3? Because they combine financial return with geopolitical value. Owning a data center isn't just profit. It's optionality in cybersecurity, cloud sovereignty, and influence over digital infrastructure decisions. Reporting in 2024-25 shows Gulf SWFs increasing allocations to exactly these sectors. Bloomberg and Reuters both flagged rising commitments to logistics, tech, and private credit, sectors critical to Europe's future competitiveness. Section 5. The political and regulatory quiet zone. How do sovereign funds avoid alarms? Through politics and law. European governments have to balance 2 pressures: protectionism and the need for capital. Countries want foreign direct investment, but fear loss of control. The solution so far has been case-by-case review mechanisms, foreign investment screening, and politics-wrapped consent. A key legal tool is the Foreign Investment Review, rules that check acquisitions of critical assets. Yet, these frameworks vary widely across the EU and individual states. Where screening is robust, funds restructure deals, acquiring through local partners or financing minority transactions that fly below regulatory thresholds. And politics plays in too. When a sovereign fund offers €1 billion to rejuvenate a derelict port or to back a green hydrogen plant, local ministers often prefer the cash over the patience of domestic capital. That creates political cover for the deal. In many cases, the media framing becomes investment for jobs. The actual governance questions, who controls the long-term rights, are buried in boardroom minutes. Global SWF data and FT analysis repeatedly note this tension, increased deal-making alongside gradual tightening of national screening. Funds adapt, legal teams redesign structures, and deals close. Section 6. Influence as a yield. Let's be blunt. For these state actors, sovereign funds are more than piggy banks. They are instruments of statecraft. When a sovereign fund invests in a country's major industrial asset, they gain access. They gain meetings with ministers, the ear of regulators, and sometimes influence in standard setting or industrial policy. They develop relationships with local banks and investment managers. They underwrite projects with national significance. That influence can be subtle, a priority meeting, a side deal, a leverage point in negotiations. It can also shape media narratives through local sponsorships and cultural investments. Bloomberg's analysis emphasizes the expansion of Gulf wealth into cultural and media assets, a soft power play that accompanies financial acquisition. We've seen examples. funds sponsoring national projects, naming rights for stadiums, and funding research centers in partnership with universities. These are not random philanthropic acts. They're investments that build goodwill. Goodwill that smooths the path for future, more strategic purchases. Sovereign wealth funds don't scream. They don't rush. They don't revel in headlines. They operate like patient architects of influence, buying the future one asset at a time. Europe is not sleeping. It is negotiating the terms of its own transformation. On one hand, there is modernization and money. On the other, questions of control, transparency, and sovereignty. The question we should ask is not whether Europe will be bought. It already is. The question is whether it will be governed, transparently, democratically, and with the public interest at its core, or whether quiet ownership will become a new, permanent form of influence. Because when cash writes the first draft of the next economy, the second draft must be written in law. This is Shadow Reports. If you want more deep dives into the unseen forces shaping power and capital in our world, subscribe. We'll lift the curtain together.